Swayam Prabha. Digital India. Educated India.
Residential mortgage products is the topic for lecture today as part of the course Real Estate Finance and Investment Strategies. So, by the end of this lecture, students will be able to understand different types of residential mortgage products available in India, compare fixed rates and adjustable rate mortgage features and applications, analyze government backed mortgage programs and their benefits, evaluate specialized mortgage products for different borrower categories, applying mortgage product selection criteria to specific borrower situations, calculate and compare cost across different mortgage products, understand current trends and innovation in residential mortgage markets. So, first let's have a recap of what we have done and the course context. So, building on previous knowledge, we have done introduction to mortgage financing in last class, and in today we will be specifically talking about residential mortgage products. So, key concepts to remember which we will carry forward from the previous class will be your EMI calculation and amortization, then fixed versus floating rate structures, then LTV ratios and qualification criteria, and tax benefits and prepayment strategies. So, classification of residential mortgage. So, primary categories. So, by interest rate structure, we can see that we include fixed rate mortgages where rates remain constant throughout the loan term. We have adjustable rate mortgages where rate fluctuates with market conditions, and hybrid mortgages which combine both structures. Then we have government backing, creates another important distinction. Conventional loans that rely purely on lender underwriting versus government sponsored programs that provide subsidies or enhanced terms. Then the third classification considers proper purposes and features ranging from standard home purchase loans to specialized programs for specific borrower categories like women, NRI or senior citizens. Finally, we have portfolio and non-conforming loans for borrowers or properties that don't meet standard criteria. This classification framework helps us organize the complex mortgage landscape and understand how different products serve different market segments. So, as we progress through today's lecture, we will examine each category in detail. So, fixed rate mortgages. So, fixed rate mortgage provides the ultimate in payment predictability with interest rate remaining constant throughout the entire loan term. So, that the biggest advantage is that we are getting constantly the same loan EMIs we are paying every time. So, we have fixed, we can plan our our budget, everything we can plan accordingly because we know what we have to pay. We are like paying fixed every time. So, consistent monthly EMI payments is the highlight of this. Predictable total borrowing cost, we know already. In floating, we don't have that awareness. And then protection against interest rate increases. So, in future, if there is a big event, economic event, global event that may impact interest rate a lot, but we will be safeguarded by that because of the fixed nature of our loan, and typically higher initial rates than floating rates because loan here the risk of this loan product is basically taken by the lender because in case there is a huge increase in future, they will be bearing the burden of that. So, typical terms in India, available tenure, you will find this for 5 to 15 years, and interest rate would be 0.5 to 2% higher than floating rates, and processing similar to standard home loans which are there, which requires the same kind of documentation which are available. Then advantages: payment predictability, aids budgeting. We can budget our what we are paying. Then protection against rising interest rates. So in future, if, like I said, bigger event has taking place, something bad is there, some major catastrophic financial event happens, so in that case we are safeguarded. And then simplified financial planning, much more straightforward financial planning. We don't have to plan for any ups and downs. We know that what we have to pay, so we can accordingly plan our other financial decisions. And peace of mind, we don't have to worry about what will be the fluctuations in the market. We know what we have to pay. So it is very good for risk averse borrowers. And then there are certain disadvantages. So you are paying higher initial interest rate. So if you are already going with a scenario where the interest rates are already high in market, and then you go for fixed rate, then in future, if the rates go lower, you don't get benefit of it, and you also pay higher initial interest rates. You are paying around, we have seen around, you can pay as high as around 2%, which is a significant amount. And then there is no benefit from falling interest rate. We have, like, already, if it is at the highest and it has to come down, then there is no sense. It can be negative for us. And limited availability in Indian market. We generally will not find such type of loans where we can have fixed rate. So if somebody is giving us, they will of course charge more for it, and may have prepayment penalties also, because RBI allows that. So we have sometimes 1.5 to 2% prepayment penalties also. That option also goes away from us, that we can prepay our loan. Then it is best suited for risk averse borrowers who don't want to take risk. They want tension free life, so they may prefer for this. Then fixed income household, where the income is fixed, their salaried household, they will try to go for it. And when rates are low and expected to rise, then also this can be a preferable option for somebody. Then we come to adjustable rate mortgages. So adjustable rate mortgages represent the most common mortgage structure in India, with rates that fluctuate based on benchmark rates. So fundamental appeal lies in lower initial rates, typically 0.5 to 2%, below fixed rate alternatives, making home ownership more affordable initially. Now, since RBI's 2019 external benchmark mandate, rate adjustments have become more transparent and responsive to monetary policy changes. Most ARMs are now linked to the repo rate, though repo rates through repo rate linked lending rates, with automatic quarterly adjustments when RBI changes policy rates. So this system ensures that rate cuts translate directly to borrower benefits, unlike previous base rate system where transmission was often incomplete. The structure involves a transparent spread over the benchmark rate, reflecting borrower's credit profile. LTV ratio and loan characteristics are also here. And then rate caps, while not universal, may limit adjustment magnitude either per period or over the loan's lifetime. RBI's prohibition of prepayment penalties on floating rate home loan provides valuable flexibility for borrowers to refinance or prepay without additional cost. So RBI also fixes that there is no prepayment penalties, which is not there in the case of fixed rate instruments. So fixed rate penalties can be imposed by the lending parties, but in the case of adjustable rate mortgages, it is not possible. RBI strictly prohibits that. So no penalties. You can prepay your loan. So this structure works best when rates are high and expected to decline, or when borrowers can handle payment variability in exchange for potentially lower long-term cost. Then we are looking at ARM rate adjustment mechanics. So repo rate, we can see that the table which we can see here, the three primary benchmark options available post 2019 RBI guidelines. Repo rate linked lending rate is most common with quarterly adjustments. We can see it is quarterly adjusted. Following RBI monetary policy, and the spread typically ranges from 1.5 to 3.5% depending on borrower's profile and loan characteristic. Treasury bill link rate adjust monthly or quarterly, offering more frequent rate changes but potentially higher spread of 2 to 4%. Certificate of deposit linked rates used by some institutions typically carry spread of 2.5 to 4.5% and adjust quarterly. And then we have periodic cap limits, which how much rate can change in a single adjustment. So for example, a 0.5 quarterly cap prevents a dramatic payment shocks. Lifetime caps set maximum rate over the entire loan term, perhaps 5% above the initial rate. However, caps are not universal in Indian mortgage and often come with slightly higher spreads. Borrowers should understand their specific rate adjustment mechanism, including adjustment frequency, spread component, and any applicable caps when selecting ARM products. Then we have ARM risk and benefit analysis. So this example illustrates ARM payment variability using a 50 lakh loan over 20 years. So starting at 8%, the initial EMI is 41,822, requiring annual payment of payment of 5 lakh, around 5 lakhs. Then if rate rises to 9.5% in year 3 to 5, the EMI jumps to 46,737, increasing annual payment nearly 59,000 more annually. Now conversely, if rate falls to 7.45% in year 6 to 10, the EMI drops to 39 and around 40,000, so reducing annual payment with it. So this EMI fluctuation, monthly EMI variable, represents the core ARM trade-off, a potential saving versus payment uncertainty. So the cumulative impact is substantial. A 1% rate change sustained over several years affect total interest payment by 8 to 12 lakhs. For borrowers with stable income who can absorb payment increases, ARM offers significant potential saving. However, borrowers must budget for worst case scenarios, ensuring they can handle maximum potential payment. So this analysis should include stress testing at various rate levels, maintaining emergency funds for payment increases, and understanding their refinancing option if rates become unaffordable. Right. So then we move to the hybrid mortgages. Now, hybrid mortgages attempt to balance the predictability of fixed rates with the cost benefit of adjustable rates by combining both structures in a single loan. The initial fixed rate period, typically 2 to 5 years, provides payment stability when borrowers are often financially stretched from home purchase expenses. Common configuration include, we have 3/1 ARMs with 3 years fixed, followed by annual rate adjustments. 5/1 ARM 5 years fixed, then annual adjustments, and then 7 ARM 7-year fixed, then annual adjustments. So the longer the initial fixed period, the higher the initial rate, reflecting the lender's extended rate risk exposure. Pricing typically falls between pure fixed and adjustable rate loans, offering a middle ground for borrowers with moderate risk tolerance. The conversion terms include adjustment mechanism and spread for adjustable period are predetermined at origination, providing transparency about future rate exposure. These products work well for borrowers expecting income growth during the fixed period. Those planning to sell or refinance before rate adjustment begins, or borrowers wanting initial payment stability without the full cost of long-term fixed rate, they can also go for this. The decision requires analyzing the initial rate benefits against the uncertainty of future rate adjustment. So hybrid mortgage is another way to go for mortgages, which combines both the worlds of fixed and floating loans. Then we have government-backed mortgages. So Pradhan Mantri Awas Yojana represent India's most comprehensive approach to affordable housing finance, providing substantial interest subsidies based on income categories. The scheme structure reflects targeted assistance for lowest income groups, EWS and LIG categories, covering annual household income up to 6 lakhs, receives 6.5% subsidies on loans up to 6 lakhs, right? And we have the next category, 6.5%. We have 6 lakhs, maximum loan amount, MIG 6 to 12, interest subsidy for 9 lakhs, and we have MIG 12 to 8 lakhs, we have subsidy of 3% for maximum loan amount 12 lakhs. So that encouraging people to buy homes, and that is why they are giving these subsidies. Also, we have to note that women ownership is mandatory for subsidy. So promoting gender equality in property ownership, that is what being encouraged by government here. So subsidy is also calculated upfront using NPV methodology and credited to the borrower's loan account, providing immediate benefit rather than annual adjustments. This scheme has revolutionized affordable housing access in India, making home ownership feasible for millions of middle and lower income families. Then coming to PMAY, financial impact analysis. So let's demonstrate the transformative impact of this PMAY through a specified example. Consider a LIG borrower with the 5 lakh annual income, purchasing a small apartment, requiring a 6 lakh loan at standard market rate of 8.5% for 20 years. Without subsidy, the EMI would be 5,207. With the PMAY, we have EMI of 3,021. So monthly saving of 2,186. So present value of subsidy approximately 8%. So discount is of 2.7 lakhs. We can see that. Then we come to certain state government housing schemes. So apart from PMAY, which is central government scheme, there are other schemes also. So other schemes like Maharashtra housing scheme, Karnataka housing programs, Delhi housing initiatives. So other governments are also bringing up their own housing schemes. So while PMAY represent the overall country central government launch schemes, these state level initiatives often target specific regional needs and demographics, creating layered benefits for eligible borrowers. So Maharashtra housing scheme provides interest subsidies specifically for middle income group, recognizing the unique affordability challenges in Mumbai and Pune market. The reduced stamp duty for women buyer, often 1 to 2% saving, can translate to 1 to 2 lakh in saving on a typical property purchase. Karnataka approach focuses on supply side intervention through subsidized land allocations. So they are looking towards the supply side. Then infrastructure development also, the thrust is there, they will provide for this. So reducing overall project costs that benefit end consumer. So once these overall costs are reduced, the supply side intervention leading to overall lower cost, it will increase the demand. So there and help the affordability criteria, and consumers will be benefited. So then we come to the Delhi's DDA scheme, which combines land availability with the financial support, financing them. So they are providing financing schemes, DDA housing scheme with easy financing, something similar to central government. So addressing the capital's unique land scarcity challenge, the fast track approval process can reduce project timeline by 6 to 12 months, indirectly reducing the cost. So that is their simplified documentation process they are bringing. Understanding these state specific programs is crucial for mortgage professionals, as combining central and state benefits can dramatically improve affordability for eligible borrowers. So when we look them together, we can see that there can be big advantages for the borrowers. So that way is another lens to look at this issue. Then we go to specialized borrower categories. So time and again we have seen that women borrowers. So government has this thrust on helping women ownership of homes for the gender equality. They want to encourage this, and so for through PMI also we have seen that home ownership in the name of women is encouraged. So that is why government is trying to do that through such schemes. So interest rate concessions of 0.25 to 0.5% reduction, specifically when the borrower is woman. Reduced processing fees, that is there for them. It may seem that 0.25 to 0.5% interest rate reduction is very modest, but over a 20-year loan period, that translates to 50,000 to 1 lakh in interest saving on a 50 lakh loan, right? Enhance LTV ratios up to 90%, reduce down payment requirement from 10 lakhs to 5 lakhs on a 50 lakh property, significantly improving the accessibility. And then senior citizens face unique challenges. So senior citizens are also given certain privileges. So including reduced earning years they have, and higher medical expenses are also there, but also have substantial property equity. So reverse mortgage addresses these needs by converting property equity into income without sale obligation. Then we also have a defense personnel category. So defense personnel receive recognition for stable employment and patriotic service through special quotas and concessional rates. The extended loan tenure during service periods acknowledges deployment related income variations. These specialized products reflect lenders' understanding that one size fits all approaches don't serve diverse borrowers' need effectively. So the key is matching borrower circumstances to appropriate specialized program while understanding the qualification requirements and benefit limitations. Then we go to NRI mortgage products. So non-resident Indian mortgage products address the unique challenges of overseas income verification. Then there is an issue of currency risk and property investment motivations. NRI lending involves additional complexity due to foreign exchange regulations, right? income documentation challenges, and different risk assessment requirements. The availability in both INR and foreign currency provides flexibility, though most NRI prefer INR loans to avoid currency risk on the liability side. The 80% maximum LTV ratio reflect heightened risk perception due to limited legal recourse and collection challenges. That is there, that we have to understand that there is a issue that in case of any mischief from the side of borrower, NRI borrower, then in that case the recourse which is available to banks are very less. They don't have the same protection which is available in Indian geographical boundaries. They don't have the same options available outside India. So, the recovery is a big issue. So, LTV ratio maximum 80%. Then we come to interest rate. So, 0.5 to 1% higher than resident rates compared for these additional risk and operational complexities. We have just understood that what are the difficulties they face. So, of course, they will try to charge more from them. And then the 30-year tenure, longer than many resident loans, acknowledge NRI's longer earning horizons, very long-term loans, because it is understood that their earning can be much higher, and they have different financial planning needs. So, documentation requirements are significantly more stringent, often requiring notarization and multiple income proofs. Overseas employee letter must be detailed, covering salary, designation and employment tenure. Foreign income statements require CA certification and currency conversion documentation. The NRE NRO account statements provide crucial evidence of fund flow patterns and repayment capability. Repayment flexibility through multiple channel accommodates NRI's diverse financial arrangements and provide options during currency volatility period. Then, self-employed borrowers represent one of the most challenging segment for mortgage underwriting due to income variability, right? So, that we go next. So, we have self-employed mortgage programs. So, they represent one of the most challenging segments for mortgage. We have income variability, we have issues of documentation gaps and complex financial structures. Traditional salaried underwriting models don't work effectively for entrepreneurs, freelancers and business owners whose income fluctuates seasonally or cyclically. Income volatility makes standard EMI structures potentially problematic during lean business periods. Seasonal businesses like agriculture related enterprises, tourism and festival dependent retailers face particular challenges in demonstrating consistent repayment capacity. The documentation gaps arise from less formal record keeping, cash transactions and complex business structures involving multiple entities or partnerships. Specialized products have evolved to address these challenges through alternative assessment methods. Bank statement based program analyze cash flows over 12 to 24 months rather than relying solely on tax returns, providing more comprehensive income pictures. Business cash flow consideration evaluates working capital cycles, seasonal variation and growth trends. Then collateral backed options provide security for lenders while reducing documentation requirement for borrowers. Enhanced requirement include 2 to 3 years tax returns, CA certifications and higher margin requirement reflect the additional due diligence needed. Business vintage minimums typically 3 to 5 years ensures borrowers have demonstrated business sustainability before major debt commitment. So, enhanced requirements are there, 2 to 3 years tax return, chartered accountant certifications, higher margin requirements. So, all these are some extra due diligences which have to be done by the bank when the cases of self-employed people, there they have to do all these safeguards. Then we go to jumbo loan and high value properties. So, jumbo loans typically exceeds 75 lakh, serve the high-end property market with different risk profiles and operational requirement than standard mortgages, right. So, the ticket size we can see that it is very high, 75 lakhs and above. So, the lower 75% maximum LTV ratio reflects both regulatory exposure limits and risk management practices for high value assets. So, we have 75% maximum LTV. One is that the government they want specified they want to regulate the exposure limit. So, one of the reason is that they have fixed this value because they don't want bank books to have higher risk, and it's not just from the regulator side but also from the bank side. We can see that they also in their risk assessment think that this can be very riskier proposition. So, they also fix a maximum 75% LTV ratio for such type of loans which exceed 75 lakhs, right. So, enhanced qualification criteria are imposed here, often include high credit scores, multiple income source, substantial liquid assets beyond down payment requirements. Comprehensive property evaluation becomes critical given the substantial amounts involved and potential market volatility in luxury segments. Premium property financing focuses on high net worth individuals who often have complex financial structures involving business ownership, investment portfolios and international assets. Relationship based pricing reflects the value of these customers to finance institutions. So, to financial institutions, and its customized loan structure might include interest only periods, balloon payments or flexible scheduling aligned with business cash flows or investment realization. Risk consideration include higher market volatility in luxury segments where price corrections can be more severe, right. In mass market properties, in comparison to mass market properties, liquidity constraints during market downturn can make property disposal challenging, and then regulatory exposure limits require lenders to manage concentration risk in high value lending portfolios. Then we have construction and bridge loans. Construction loans serves borrowers building custom homes or purchasing under construction properties, requiring different structures and risk management approach than completed property mortgages. Stage disbursement based on construction progress protects lenders from project abandonment risk while ensuring builders have adequate funding to complete work. The typical disbursement schedule shown here reflects standard construction milestones, with each stage representing verifiable progress that maintains the property value progression. Foundation and plinth work at 20% establishes the building's basic structure and legal status. Walls and roof completion at 30% creates weather protection and substantial asset value. Door and window installation at 25% represents significant finishing progress towards habitability, and final finishing work at 20% covers flooring, painting and fixture installation. The final 5% upon completion certificate ensures all regulatory approval and occupancy permission are obtained. Higher interest rates during construction, typically 0.5 to 1% above standard home loans, reflect the increased risk of incomplete projects and construction delays. Technical inspection requirement ensure disbursement match actual progress. Protecting both lender and borrower's interest. Conversion to permanent mortgage upon completion typically involves rate reduction and term extension, transitioning from construction financing to standard home loan structure. This product serves custom home builders, plot plus construction financing, and under construction property purchase where buyers and construction linked payments to buyers need construction linked payments to developers. Then we have reverse mortgage. Now, reverse mortgage represents a fundamental shift from traditional lending, allowing senior citizens to convert property equity into income without monthly EMI obligation or ownership transfer during their lifetime. This product addresses the common problem of asset-rich, cash-poor seniors who own valuable properties but have limited retirement income. 60+ age requirement reflects life expectancy considerations and regulatory consumer protection measures. The absence of monthly EMI payment eliminates affordability constraints that would prevent seniors from flexibility while protecting lenders' interest through property collateral. Retained property ownership during lifetime addresses seniors' emotional attachment to their homes and desire to age in place. Payment options provide significant flexibility. Monthly annuity payment creates predictable income streams similar to pensions. So, lump sum options address major expenses like medical treatment or home renovation. Line of credit facilitates provide access to funds as needed, potentially offering better return through unused credit growth. Combination approaches allows customized solution for individual financial needs. Key limitations include lower 60 to 70% LTV ratios, reflecting longevity risk and property maintenance concern. Limited property types focus on easily marketable residential properties. Mandatory counseling requirements ensure senior understand the product's long-term implication and alternative before commitment. Right. Now, let's look at interest rate comparison analysis. So, this comparative analysis illustrates how different borrower category and product types affect pricing structure in the current market environment. So, standard home loan serving salaried borrowers with good credit profile typically offer the most competitive rates in the 8 to 9.5% range, reflecting lower risk and standardized underwriting processes. Women borrowers benefit from social policy initiative and statistical performance advantages, receiving 0.25% rate concession that translates to substantial long-term savings. NRI loan commands premium pricing. Right? After women, we can go to NRI. NRI loan commands premium pricing due to additional operational complexity, foreign exchange consideration, and limited collection option in default scenario. Then we have self-employed. We have understood that how difficult it is for banks to actually ascertain, financial bodies to actually ascertain the self-employed financial strength. So, for that interest rate ranges are higher for them because there is difficult to assess their financial situation. So, because of this income volatility and documentation challenges, they are charged higher rates. And then we have jumbo loans, which we have seen that which are given to above 75 lakhs. So in that case also, we can see that the rates can vary a lot, but they are also generally on the higher side even compared from standard home loans. Right. So, the factor affecting these rates are not just this, but beyond that. So, we can see that credit score, that also impacts the income profile, that also impacts the kind of loan rates we are getting. And so, for example, credit score of 750 above can reduce rate by 0.5 to 1%. LTV ratios where lower leverage improves pricing, and property characteristics including location, type and age. So basically all these can impact. Then understanding these pricing dynamics help both borrowers optimize their application and professional provide accurate cost guidance also. So these are some interest rate comparison analysis. Then we move to mortgage product selection framework. So systematic mortgage product selection requires a structured approach that matches borrower's characteristics. So here we can see income stability and growth prospects. So if the borrower has income stability, it is appreciated. Growth prospect analysis considers career trajectory, age and industry dynamics. Young professionals expecting rapid income growth might choose step-up EMI structures or initially lower payment products. Risk tolerance and payment flexibility, that is also there. So risk tolerance assessment determines appropriate interest rate structures. Conservative borrowers preferring payment certainty should consider fixed rate despite higher initial cost, while those comfortable with variability can benefit from ARM potential savings. Then credit profile evolution affects product availability and pricing. Excellent credit opens all options with best rates, while impaired credit might limit choice to specialized or government-backed programs. Step 2 will be product matching. So product matching process requires analyzing current interest rate environment. When rates are historically low and expected to rise, fixed rate products provide valuable protection, while high current rates favor ARMs expecting future declines. Government program eligibility can provide massive benefits through interest subsidies, making PMAY evolution essential for qualifying borrowers. Step 3 is lenders comparison, encompassing not just rate and fees, but service quality, processing speed, and relationship benefit for future financial needs. Then we have cost comparison methodology. So total cost of ownership analysis provides the most accurate method for comparing mortgage alternatives, encompassing all cost over the loan's lifetime. So rather than focusing solely on interest rate, interest payment represent the larger component, calculated using EMI's formulas and varying significantly based on rate structure and term. Processing fees, while seemingly minor at 0.5 to 1% of loan amount, can represent 25,000 to 50,000 on typical loans and vary substantially between lenders and products. So processing fees is also something we have to think about. Insurance premiums for property and life coverage, often mandatory for mortgage approvals, adding ongoing cost that differ between lenders and programs. Prepayment penalty potential affects future flexibility, while floating rate home loans cannot charge prepayment penalties as per RBI regulations. Some fixed rate and specialized products may include penalties affecting refinance or early payoff strategies. Tax benefit implications through Section 24B and Section 80C deductions can reduce effective borrowing cost by 20 to 30%. So tax benefit implications are also there. Then the comparison examples which is given here demonstrates dramatic cost difference. We can see for fixed rate, for ARM and for PMAY, clear difference in rates we can see, and the total cost which is there, right. So we can see that the 3.3 lakh difference between fixed and ARM loan over 20 years represent nearly 8% of the original loan amount. PMAY subsidized rates create 23.39 lakhs saving compared to standard products, illustrating why government programs eligibility should be thoroughly evaluated. This methodology should include sensitivity analysis for ARM products. So, sensitivity analysis of plus minus percentages should be done here, considering various rate scenarios to understand potential cost ranges rather than single point estimate. Then let's take one small case study of young professional to understand this. So the case study illustrates practical application of mortgage selection principle for a common borrower profile in today's market. This 28-year-old software engineer represents the demographic driving much of India's urban housing demand. Young, well-educated professional with strong income growth prospect but limited accumulated wealth. The 15 lakh annual income place him in upper middle class category with good affordability but insufficient for jumbo loan programs. Expected 8 to 10% income growth reflects typical IT sector career progression, suggesting capacity to handle increasing payment over time. The 80 lakh apartment in Bengaluru represent typical pricing for quality housing in major IT hubs, requiring substantial financing even with 20 lakh down payment. Option 1 standard ARM at 8.5% provides maximum rate flexibility and RBI mandated prepayment freedom. Right. The 52,000 the MI of around 50,000 represent 42% of the gross income, approaching but not exceeding typical affordability guidelines. Then option 2 we have of hybrid 5:1 structure. So that is there. And then we have option 3 of step up EMI, which starting at more comfortable 45,000 EMI with 5% annual increase. So basically these are the options which they can go for. So the hybrid mortgage recommendation balances immediate affordability with future flexibility, providing payment certainty during crucial first 5 years while maintaining ARM benefits thereafter. So we have these type of situations. We have different types of options which a young professional can go with, and they can compare and find out. So this is one illustrative example, but there can be many, and everyone who right now in this board, they can analyze on their own these different options which they have and decide which is best for them. Another case we have of NRI investment. So here we can see that we have different options, and we can assess that this complex financial dynamics of overseas property investment and the importance of comprehensive flow analysis. This Dubai based professional earning $60,000, around 50 lakh rupees, represent typical middle managed NRI income level, sufficient for property investment but requiring careful leverage analysis. The 1.2 crore Pune property reflects NRI preference for tier 1 city real estate, offering potential appreciation and rental income. 75% LTV, right? It leads to 90 lakhs loan amount and interest rate of 9%. So EMI comes at around 89,121, and the rental income is this right? So for good quality property in Pune, this is there, but it creates substantial negative cash flow of 6.5 lakh annually. This negative carrying cost must be funded from overseas income, requiring 54,167 monthly support from Dubai earning. The analysis reveals that while the investment may provide long-term appreciation, the immediate cash requirements are substantial, because every month there is a big outflow of money which has to be there. So, alternative strategy might include lower leverage at 50 to 60% LTV to reduce debt service, property selection focused on higher yield assets, or delayed investment until rental market improves. This case emphasizes the importance of comprehensive financial modeling for NRI property investments beyond simple affordability calculations. Then we go to digital mortgage innovations. So, digital online, we have seen online applications and approval processes can be now streamlined, much more easily done. We have AI powered credit assessments. Quickly they can be done. People can on their own find out their credit status, and then digital document verification, faster document verification can now be done. So, a lot of mortgage institutions are now making it online, this process. Then blockchain is also coming for security purposes for property records, and it's very good for safety and security. Then benefits of this faster processing. So earlier from 30 to 45 days, it has drastically reduced to 7 to 15 days. The documentation requirements are also reduced a lot. Transparent tracking and communication is now being achieved, and lower processing costs are also there because less human intervention is now required. And leading digital platforms will be your HDFC Bank's digital home loans, ICICI Bank instant home loans, fintech partnership for streamlined processing. So, lot of fintech is coming into this area, financial technologies is coming into this area and making the process faster and smoother. Then we have current market trends. So, competitive pressure keeping rate low, rate environment is very healthy. RBI repo rate transmission is improving day by day, and spread compression benefits to borrowers is there. Then product innovations, lot of new products have been launched by different lending agencies, companies, and they are offering flexible EMI options, top up loan facilities. Then balance transfer simplifications is being done, and then green building incentives are also being provided. So there are lot of such type of different products available in market. Then regulatory developments are also taking place, enhanced consumer protection. There is a lot of institutional support in the forms of regulation, making more transparent the whole business, and standardized documentations are now part of the game. And then improved grievance mechanism where the portals, online portals are created. Government is getting aware of problems immediately. So there are these safeguards also available. Then risk management for borrowers. So rate cap products were available, they should go for that. Interest rate risk gets controlled. Budget for potential EMI increases, that is there. They should keep that thing in mind, if especially they are going for flexible products. Emergency fund maintenance, in case of when they are taking such huge loans, they should be also protected with emergency funds. So in case of any emergency in their own life, they should have funds, and so that they don't lose their homes. And refinancing options are should also always be evaluated. Then employment risk, income insurance consideration should be there. Diversified income sources, if they are there, it is better. Conservative debt to income ratios, so that should also be kept in mind, that your debt is in a limit. And liquid saving maintenance, so you have proper saving maintenance, so that you can save for difficult times. And then property risks are also there. Comprehensive property insurance should be done for that. Location and quality selection, what kind of location, what is the quality. So once you have decided on a home and you have taken loan, so you should not second guess your decision. So location and quality selection should be done properly. And market condition awareness should also be there, that what is the right product for you, and when you should go for actually taking the loan. Then prepayment strategies per product type. We have discussed that fixed rate, there can be penalties, but ARM there is no penalty. So definitely prepayment strategies should be made by the investors. They should go for it. And government subsidy loans, if investors can avail that, we have seen that there is a substantial saving which can be achieved by them. Future outlook, we understand that green mortgage products, energy efficient homes, they are being expected. A lot of such products are also coming for them, loan products. Then flexible payment mortgage tied to income volatility is there now, being because of the kind of job market we have. AI driven personalized mortgage products are there. So AI is being used more and more. Cryptocurrency integration possibilities are there. So cryptocurrency, such type of new models are also being brought in. Then market expansions, tier 2 and tier 3 city they are now in focus. They are fast developing. Affordable housing segment is growing because of the government initiatives. We have co-living and co-ownership financing, rental yield based underwriting. So these are the new expansions of the market. And then regulations are also improving very quickly and very dynamic in nature. So key decisions, what rate structure you go for, fixed, ARM, hybrid, what program you are selecting, government program, central or state, and lender selection, what lender you are going with. So that which is rate sensitive rate you can compare. So basically we have covered this different products here, and this is the summary, the overall takeaway from this lecture. Hopefully this has added to your knowledge, and you will understand about these products more on your own. Thank you so much.